In this video, we're going to go over Chapter 6, the General Rules of Revenue Recognition. First, let's go over the basic rules of revenue recognition. So, in accounting, the definition of a revenue is resource inflows from already having either having performed a service or given up possession of goods. So let's talk about the first one first, resource inflows. Under accrual accounting, we do not have to receive cash, so there are several other things that we can also receive in order to show a revenue. So first of all, you can receive property. So for example, let's say you typed your friend's term paper and they couldn't afford to pay you cash, so instead they gave you their iPod. So instead of debiting cash, you just debit iPod and then you'd credit service revenue. So even if you didn't get it in cash, you would still have the revenue. And also in accounting, because we have accrual accounting, you can also have a promise to pay. So unless you receive either cash property or a promise to pay, there's no revenue. I've always had a hard time coming up with the giving up possession of goods but not getting a promise to pay. The best example that I can give of that, if you're a famous fashion designer, and let's say you ask a famous star to wear one of your gowns to the Oscars. So you give the gown to the famous star, but they don't have to pay you. So even though you gave up possession of goods, a revenue doesn't exist because you have no resource inflows. So I hope that makes sense. Now let's look at the other side from already having either performed a service or giving up possession of goods. So the other side of a revenue is matched to the period of time in which it is earned. So services are going to be matched to the period of time when the services are performed. An example that I give in Principles of Accounting, if a lawyer performs services in December, the bill is typed out in February. Bill is typed in January. I was getting ahead of myself. And the client pays in February. This is still considered a December revenue. You would not be allowed to put it in any period. In fact, even if you found it in January, you would not be able to stick it in January because under GAAP, under the rules of generally accepted accounting principles, you have to match revenues to the period of time in which it's earned. So if you found that out later in January, you would have to do what is called a prior period adjustment and adjust your beginning balances for January as if you had recorded the revenue in the correct period of time. So you don't move it around. Revenues are always matched to the period of time in which they're earned. For services is when the services are performed. For inventory sales of goods, it's when it passes the FOB point, and we'll get to that when we go over inventory. Now, let's go over some new rules relating to revenue and then some exceptions to the revenue recognition principle. So these are brand new rules for revenue recognition. They've only been out for about 4 or 5 years right now. And in fact, companies only have to follow them for about the last 2 or 3 years. But the new rules for revenue recognition relate to when you have separate and distinct product and services. So I'll try to explain that in a moment. So, for example, let's say I'm Dell Computer Company and I sell a computer, or I sell a computer with a standard warranty. That is just one product, and I can use the revenue recognition rules stated above, that as long as the product has passed the FOB point in the contract to the customer, then I can recognize the sale in that period. But let's say Dell Computer Company has a special, and they offer not only the computer and the warranty, but they also offer you 1 year of free upgraded tech services. Now, what they've done is they've sold you two products for the price of one. Not only have you been sold the computer, but you've also been sold the tech services as well. Now, this is very important. What's going to happen is you earn the revenue for the computer when the computer is sold, but you don't earn the revenue from the tech services until the year is over. So if you offer 1 year of free tech services, that's actually deferred or unearned revenue, and you actually don't earn the revenue until the end of the year when all of the tech services have either been consumed or the right to future tech services have expired. So at the end of the year, you're all done. You can't get more tech services in the future. So what we're going to have to do is, if a computer is sold along with premium tech services, and that's just an example, there are several examples in the book of bundling of goods and services or bundling two goods together. So for example, if you buy a product and they give you a right to a future upgrade, and this is important too, that the second product also has a market value, can be sold separately. So if that happens, the company is actually selling you two products. You have to allocate the revenue to the two products and then learn when the revenue from each of the products sold is actually earned. So let's go through the 5 steps under the new rules for revenue recognition. Okay, so step 1 is to identify the contract with the customer. So in the case above, if I'm selling a computer along with free premium tech services, there's actually 2 contracts. There's the contract to sell the computer, and then there's the contract to provide the tech services. If I sell a gym membership and I promise to give them free yoga classes in the future, then there's two products. I'm selling the gym membership and I'm selling the yoga classes, as long as they can pay for the yoga classes separately, as long as it's not included with that gym membership. So once again, there are many examples of bundled products or bundled products and services. So you have to identify the contract with the customer. Then in step 2, you have to identify all of the performance obligations. So for the computer company, am I all done once I deliver the computer? Do I have to do nothing else except provide a warranty, which just assures that it's working the way that it's supposed to work? So a warranty is not considered a separate performance obligation. But did I just sell the computer, or did I sell the computer along with tech services, or did I sell the computer along with a coupon for 30% off a printer, or did I sell the computer along with a coupon for 50% off a particular software? So you have to identify what the performance obligations are in the sale. Then in step 3, you're going to determine the transaction price. So it could be a bundled price. We're going to see in some of the homework problems with coupons and other things, there may be a probability as to whether the customer is going to use the coupon or not. So we're going to calculate the most likely amount. So we have to determine the transaction price. Once we determine the transaction price, then we allocate the transaction price to each performance obligation. So in the example above with the computer and the premium tech services, we're going to figure out how much revenue we're going to earn from selling the computer and how much revenue we're going to earn from selling the tech services, because again, they're going to be recognized at different points in time. So in step 4, we figure out, okay, of the package price, how much of that relates to the computer and how much of that relates to the tech services. I have a video relating to how we allocate the separate performance obligations, and we're going to go over a problem in just a few minutes where we allocate the separate performance obligations. And then finally, in step 5, we recognize the revenue when each performance obligation is satisfied. So I'm going to do homework problem number 5. In order to do that, that will actually be in a different video because this video will be way too long if I do homework number 5 along with this video. Now that we've gone over the rules for revenue recognition, let's go over a couple of exceptions. And homework problem 8 to 12 is a particular exception. Long-term construction contracts, one of my favorite problems to do in revenue recognition. So watch for a separate video where I'll do the homework problems 8 to 12, long-term construction contracts. Okay, so we have basically 2 general exceptions to the revenue recognition principle. Exception number 1 is when revenue has already been earned, but we don't want to show it. And an example of this type of exception is installment sales. Installment sales happen when collection of the full amount is judged extremely unlikely. So an example of this is vacation home property. So what happens with vacation home property is they advertise a piece of land in a forest somewhere or out by a lake somewhere, and the land is only like $15,000 or $20,000. So if you get a 10 or 15-year mortgage, it's only like $300 a month. So you're thinking, wow, for $300 a month, this is great. I can go on vacation to the same place every year. But after about 4 or 5 years, you're thinking, oh, I'm going to the same place for vacation every single year. This year, I'd rather go to a tropical island or go skiing, right? So you get tired of it. So what happens is people just stop making the payment. And the vacation land company, they don't care because they got the money from you for 4 or 5 years. They take repossession of the vacation land and then they just sell it to somebody else. So it's actually relatively low risk for them. But if they recognize the revenue at the time of sale, which is what happens because you take out a mortgage and you make a promise to pay, what happens is after 5 years they'd have to back it out and redo all of their former financial statements to back out all of the profits. So it would be really difficult. So what happens is when collection of the full amount is considered unlikely, you recognize the revenue when the cash is received as opposed to when the revenue is earned. The second exception to the revenue recognition principle is revenue has not been earned, but GAAP is going to allow you to recognize it. And the big example of this one is long-term construction contracts. So what happens is, if you have a construction contract, I usually use the example to build a bridge, because building a bridge is very complicated. You can't do it in a week. It may take you several years to build a bridge. But if you're the construction company and you're building a bridge, during those years that you're constructing the bridge, you're going to have to pay for all that steel and all that equipment. You're going to have to pay all those salaries. But technically, you don't earn the revenue until the bridge is delivered when it's completed. So what happens is all those years you're building the bridge, you're going to show huge losses because you're showing all these costs, all these expenses, but you have zero revenues because you haven't delivered the bridge. So under accounting for long-term construction projects, GAAP will allow you to recognize the percentage of revenue under the contract based on the percentage complete. So if you're 25% complete with the bridge, they're going to allow you to recognize 25% of the revenue under the contract. So let me write that down so you get a gist of it. But look at the video for homework problems 8 to 12 on the long-term construction contract, where I'll go through actually the journal entries and how it all works. So that was a long time typing with no talking. So let's say, for example, that you have a contract to build a bridge and you're going to bill them $10 million to build the bridge. So once you finish building the bridge, the customer is going to pay you $10 million. If at the end of year 1 you decide that you're 25% complete with building the bridge, you can now show 25% multiplied by the $10 million, which is $2,500,000 of revenue in year 1. And again, technically you haven't earned it yet because the bridge is not complete. You haven't delivered it yet. But to offset all those costs you have under the long-term construction contract, GAAP will allow you to recognize that amount of revenue in year 1 to offset the costs. Now, year 2 gets a little bit more complicated because you have to look at the difference in the revenue. So let's say by the end of year 2, you're 60% complete. So up to this point, you can now show a total for the 2 years of 60% multiplied by the 10 million, which is $6 million of revenue, to date. But you already showed 2.5 million in year 1. You're not allowed to recognize it twice, so in year 2, you can recognize 6 million minus 2,500,000, which equals 3,500,000 in revenue. Now year 3 is easy. Just recognize whatever revenue has not been recognized so far. So in this case, at the end of year 2, you would have shown 2.5 million in year 1, 3.5 million in year 2. So you would have recognized 6 million so far, 60% complete at the end of year 2. So you have 4 million of revenue left to recognize in year 3 because the total contract price is 10 million. So to wrap it up, if you add 2.5 million recognized year 1, 3.5 million recognized in year 2, and 4 million recognized in year 3, that will add to that contract price of $10 million. So that was a long time to go over revenue recognition, but we learned the rules for revenue recognition, we learned our new rules for revenue recognition, and we learned our 2 exceptions to the revenue recognition principle. And make sure to take the short quiz on this video.